Dalio Marco Mind. So today, the Federal Reserve is meeting, and for the first time in modern history, it is trapped in a position where it cannot cut rates, cannot raise rates, and cannot openly explain why oil is at $100. Inflation is sitting at 3.1%. The economy is slowing. And the man leading the most powerful monetary institution in the world is under criminal investigation by the president who is preparing to replace him. The Fed is paralyzed. In public, they will pretend that nothing has changed. In private, the math has already made the decision for them. And gold, which has been quietly absorbing a signal the Fed cannot openly send, is now entering the phase that has historically produced the biggest moves in its entire price history. By the time Powell finishes his press conference today, the markets will have delivered their verdict. So you may stay not on the rate decision, because everyone already knows the rate decision. The real verdict will be on something far more important: whether the Federal Reserve still has any room left to maneuver at all. And according to Ray Dalio, the answer is no. But the true story is not the rate hold. It is not the press conference. The true story is what this FOMC meeting reveals about where we are inside the three-phase gold bull market, and why the phase beginning now has historically delivered returns that make phase one look like nothing more than a warm-up. Ray Dalio's assessment of the Federal Reserve's condition on March 18, 2026 was one of the clearest diagnoses of central bank paralysis he has given in 40 years of watching institutions wrestle with the impossible mathematics of late cycle debt. What he said about the difference between a central bank that chooses to hold rates and a central bank that is forced to hold them, and what that difference means for gold, for bonds, and for every dollar-denominated asset you own, is something every investor needs to understand before this press conference ends. Here is what is happening inside the Fed today, and why the gold market already knows what Powell will never say directly. At 2 p.m. Eastern Time today, March 18, 2026, Jerome Powell will step to the podium and announce that the Federal Reserve is holding interest rates at 3.50% to 3.75%. The market probability of that outcome, according to CME FedWatch this morning, is 99.2%. That is not a surprise. It is not even really a decision. It is a mathematical inevitability. But here is the number that matters most. Not the rate, the trap. On one side of that trap is core PC inflation running at 3.5%, so, and display situation 1 percent year over year as of January 2026, with a month-over-month increase of 0.4%, moving in the wrong direction at the worst possible moment. Brent crude reached an intraday peak of $126.50 per barrel in the weeks since Operation Epic Fury began on February 28th. Every dollar oil rises adds cost push pressure to an inflation metric that was already 55% above the Fed's 2% target before the first bomb even fell on Iran. On the other side of the trap is GDP growth of just 0.7% in Q4 2025, down sharply from 4.4% in Q3 2025. Unemployment is at 4.4% and rising. Manufacturing has been contracting for 9 straight months. The American consumer is already absorbing roughly $1,500 per household in tariff costs, plus another $60 to $150 per month in electricity surcharge pressure tied to the Canada trade war. And now the economy is beginning to feel the first wave of oil-driven gasoline and grocery price increases that have not yet fully shown up in CPI data. So the Fed faces 3 impossible choices: cut rates to fight recession, and it reignites the inflation that oil has already made worse; hold rates to fight inflation, and it accelerates the slowdown that 126 oil and rising unemployment are already creating; raise rates, and it detonates the $9.2 trillion in Treasury debt that must be refinanced this fiscal year at rates already producing around $1 trillion a year in interest costs. There is no fourth option. The Fed is trapped And Powell, who is now being criminally investigated by the DOJ for refusing to cut rates on the president's command, will stand at that podium today and describe this trap in such carefully controlled language that most investors will hear nothing at all. Gold heard it months ago. And this is where things start getting dangerous. The number you really need to understand is not 3.1%. It is not 99.2%. It is $245 billion. That is the cumulative loss the Federal Reserve has recorded on its own balance sheet since 2022. A loss the central bank is legally allowed to describe as a deferred asset instead of insolvency because it effectively writes its own accounting rules. Let me make that even clearer. The Federal Reserve is paying banks 3.65% interest on the reserves they keep parked at the Fed, and those reserves now total more than $3.3 trillion. But the assets sitting on the Fed's balance sheet, the Treasury bonds and mortgage-backed securities it bought during COVID, are yielding far less than 3.65%. So the Fed is paying champagne prices for beer-quality assets. The result is $245 billion in cumulative losses. This is a central bank that would be considered technically insolvent under normal private sector accounting standards. This is not a rounding error. It is not a technical footnote. It is not some minor accounting distinction buried in the back pages of monetary history. The institution managing the world's reserve currency has been running losses for 3 consecutive years, is carrying those losses on its books as a fictional asset, and is being asked to navigate the most complex stagflationary environment since 1979 without the tools previous Fed chairs used to escape similar moments, because those tools have already been used. And then in December 2025, the Fed quietly began creating $40 billion per month in new liquidity to buy short-term Treasury securities. They did not call it quantitative easing. They called it reserve management purchases. They did not hold a press conference. They did not issue a major statement. They did not send out a serious press release to financial journalists. They simply started doing it. $40 billion a month. Created from nothing to buy government debt the market was not absorbing fast enough at existing prices. This is phase 2, and it began 3 months ago. Ray Dalio has spent 4 decades identifying the exact point when a gold bull market shifts from phase 1, the quiet institutional repositioning phase, into phase 2, the phase driven by the market finally realizing that the central bank has lost the ability to control the monetary system without choosing between 2 different forms of destruction. His framework is precise. Phase 1 produces steady, methodical gains in gold as sovereign wealth funds and central banks quietly reduce their exposure to the dollar. Central banks bought 1,037 tons of gold in 2023. They bought 1,045 tons in 2024. They bought 863 tons in 2025. That is 3 straight years at roughly double the historical average. And every year they kept buying even as prices rose, meaning each ton was more expensive than the last. Phase 1 does not care about the price. It cares about allocation. And phase 1 does not end when central banks stop buying. It ends when the general market finally understands why they were buying. Phase 2 begins with a specific realization, not the crisis itself, but the market's realization that the central bank cannot respond to the crisis through conventional tools. In 1971, it was Nixon closing the gold window. In 1979, it was the Fed under Volcker being forced to choose between killing inflation with 20% interest rates or killing the economy with those same rates. In 2026, it is this FOMC meeting on March 18th, the meeting where the Fed holds rates at 3.50% to 3.75%, while oil is at $100, inflation is at 3.1%, GDP growth has collapsed to 0.7%, and the incoming Fed chair has been nominated specifically because the president believes he will cut rates regardless of what the data says. Phase 2 is not the moment the Fed is forced to print money. Phase 2 is the moment the market concludes that the printing is inevitable and starts pricing that conclusion into gold before the printing becomes official. Now let's break this down layer by layer. Layer 1 is the impossible math of the $9.2 trillion refinancing wave. The United States must roll over $9.2 trillion in maturing federal debt this fiscal year. At current rates of 3.50% to 3.75%, the annual interest cost is already about $1.03 trillion. That is the first time in American history that interest payments have exceeded the entire defense budget. If the Fed raises rates to fight oil shock inflation, the refinancing cost of that $9.2 trillion arises by tens of billions of dollars for every 25 basis point hike. If the Fed holds rates while inflation remains at 3.1%, then the real yield on existing Treasury debt turns negative, meaning foreign creditors holding $7.6 trillion in U.S. government bonds are earning less than the rate at which the purchasing power of their investment is being destroyed. And if the Fed cuts rates to support the economy, it throws more inflationary fuel onto a fire oil has already pushed beyond the Fed's own comfort zone. Every path carries a cost, and every cost ultimately lands on the credibility of the dollar. Layer 2 is the Warsh succession trap. Kevin Warsh is expected to take over as Federal Reserve Chair in May 2026. He was nominated by a president who has publicly demanded rates at 1% or lower, and most recently in a Truth Social post on March 12th, openly asked where Jerome Powell was and who directed the DOJ to serve grand jury subpoenas on the current Fed chair. Warsh has called the Fed broken. He has demanded regime change. He has publicly aligned his analytical framework with the administration's preference for lower rates. So when he takes the chair in May, the market will face a binary test. Does Warsh cut rates even though an oil shock is driving inflation at 3.1%? Or does he resist the pressure from the president who appointed him and hold the line? Either answer confirms phase 2. A cut confirms that Fed independence is gone and monetary debasement has started. A hold confirms the stagflationary trap is real and the economy is heading into recession. Gold wins in both outcomes. The only uncertainty is timing. Layer 3 is the private credit time bomb. Historically, the trigger for phase 2 has often come from the financial system, not directly from government. In 1929, it was the stock market. In 2008, it was housing. In 2026, the most leveraged and least transparent corner of the system is private equity and private credit. Together, they hold around $4 trillion in assets, with roughly $440 billion trapped in zombie funds more than 10 years old that still cannot sell their underlying companies. These funds have been using continuation vehicles, selling assets to themselves, and borrowing against estimated valuations on companies they cannot actually sell, all to avoid recognizing losses that would trigger investor redemptions. But when those losses are finally forced into the open, whether by recession, rising default rates, or the credit cycle turning, those losses will flow into the banking system that lent to them, and that banking system, already suffering negative real yields on reserves parked at the Fed, will need support. And the only institution that can provide that support is the Federal Reserve. And the only tool the Federal Reserve has to provide that support is the very one it has already quietly started using at $40 billion per month under the harmless name reserve management purchases. Dalio described it this way in his framework on Phase 2 gold dynamics and central bank credibility loss. In 40 years of managing capital across every major monetary transition in the modern era, I have found one consistent diagnostic for the moment when a gold bull market enters its most powerful phase: the market's realization that the central bank has lost the ability to choose its policy response and has been reduced to managing the timeline of an outcome that is now inevitable. That realization does not arrive through one dramatic announcement. It arrives through a sequence of signals. A rate hold when cutting is economically necessary. A money printing program renamed so nobody calls it printing. A criminal investigation of the outgoing chair. A nominated successor whose independence is publicly in doubt. These signals accumulate until the conclusion becomes impossible to deny. The Federal Reserve's March 18th March 18th meeting will not produce a surprise. It will produce a rate hold. But the signal inside that hold, the signal that the Fed is trapped between inflation and recession, with $9.2 trillion in debt to refinance and $245 billion in losses on its own balance sheet, that is the phase 2 signal. Gold has been pricing it in for 3 months. The rest of the market is about to catch up. He then continued with a comparison to 1979. The parallel is not exact, but it is revealing. Volcker inherited a Fed that had already lost credibility after years of accommodating inflation. His response, 20% interest rates, was economically brutal, but politically survivable only because the alternative was hyperinflation. The Fed of 2026 faces a similar credibility problem with very different constraints. It cannot raise rates to 20% because the interest cost on $36.2 trillion in federal debt at 20% would be about $7.2 trillion per year, roughly 5 times the entire federal discretionary budget. It cannot print money openly because inflation already embedded into the system by oil would accelerate to politically catastrophic levels. So it does what central banks always do in this kind of configuration. It acts quietly. It calls money printing reserve management purchases. It calls insolvency a deferred asset. It holds rates steady and claims that nothing has changed. And gold, which has no balance sheet to hide behind and no press conference to manage, simply prices the gap between what the Fed says and what the math demands. Dalio closed with this. In 40 years, I have watched Phase 2 gold dynamics unfold in every country where the central bank lost the ability to choose between competing mandates. The 1979 Iranian Revolution pushed oil above $40 per barrel, and gold responded with a 276% gain in 12 months. Not because people bought gold out of fear, but because the mathematics of the monetary system made the debasement of the dollar mathematically certain. And gold is the asset that prices that certainty before the central bank admits it. What I'm watching on March 18, 2026 is the Federal Reserve holding rates at 3.50%, while oil trades at $100, core inflation runs at 3.1%, GDP growth collapses to 0.7%, and the incoming chair has been nominated by a president demanding 1% rates. Every one of those numbers is a Phase 2 signal. Together, they form the most complete Phase 2 configuration I have seen in 40 years of watching central banks navigate the impossible. Gold is at 5,100. Phase 2 targets from JP Morgan, Deutsche Bank, and Goldman Sachs range from $5,900 to $6,300. The distance between those two numbers is not merely a forecast. It is the mathematical consequence of what happens when Phase 2 of a gold bull market is confirmed, and today's Fed meeting is about to do exactly that, whether Powell intends it or not. And the market scorecard confirmed every part of that framework before the FOMC statement was even released. Gold opened March 18th at $5,085, holding the structural support level Ray Dalio identified 3 weeks ago as the Phase 2 accumulation floor. The gold-silver ratio stood at 57, suggesting silver is positioned for the kind of leveraged outperformance it has historically delivered in every major Phase 2 gold move. Mining stocks, whose margins can triple when gold rises 50% because their production costs remain relatively fixed, are still trading roughly 20% below their theoretical value at current gold prices because retail investors have still not fully arrived at the Phase 2 thesis. The 10-year Treasury yield remained elevated at 4.14%, refusing the classic flight to safety move that usually pushes yields lower during equity volatility. That refusal is not just a bond market signal. It is a Phase 2 signal. It means the bond market is simultaneously pricing the 9.8 idan dor 1 more dans $2 trillion refinancing wave, the Fed's $245 billion losses, and the oil shock, and concluding that the risk premium required to hold long-duration dollar assets is rising, not falling. The U.S. dollar index weakened to 98 after the December jobs report and has remained volatile since then. A dollar that cannot strengthen during a global crisis when historical precedent says it should is a dollar whose safe haven premium is starting to be questioned. That questioning is another Phase 2 signal. Gold miners tell the same story. Shares outstanding in the GDX ETF declined 20%. The GDXJ Junior Miners ETF lost nearly one-third of its shares outstanding, even while the underlying stocks were moving higher. Retail still has not arrived. Institutions are already positioned, and the gap between where institutional behavior is and where retail awareness still is, the same gap that defined the Phase 1 accumulation window, has now become the Phase 2 window. One type of investor is watching today's FOMC rate hold and concluding that nothing has changed. The Fed held rates. Inflation is being managed. The crisis is contained. That investor will not act until the Phase 2 move is visible to everyone. And by then, most of the structural gain will already have been distributed to the investors who understood the framework earlier. The other type of investor is watching the exact same rate hold and recognizing the Phase 2 signal hidden inside it. A central bank that cannot cut because of oil, cannot hike because of debt, cannot print openly because of inflation, and is about to be replaced by a chair whose independence is publicly in doubt, while quietly creating $40 billion per month in new liquidity under a name almost nobody is supposed to notice. This is not just a Federal Reserve story. It is not just an interest rate story. And it is not just a gold price story. It is a story about the three-phase framework that has governed every major gold bull market in recorded history, and about the specific, datable, confirmable moment when Phase 1 ends and Phase 2 begins. That moment is today, March 18, 2026 at 2 p.m. Eastern Time, when the most powerful central bank in the world holds rates steady because it has no other choice. And gold prices, the gap between what Powell will say and what mathematics has already decided. Phase 1 turned 10,000 into 35,000. Phase 2 of the 1970s gold bull market turned $10,000 into $243,000. So, the question Ray Dalio is asking, and the question every gold holder, every silver holder, and every investor with a dollar-denominated retirement account should be asking today, is not whether Phase 2 has begun. The math has already answered that. The real question is which side of the Phase 2 threshold you are standing on when Powell walks away from that podium. Because Phase 2 does not wait for public confirmation. It begins the moment the central bank's paralysis becomes undeniable. And today at 2 p.m. Eastern, that moment arrives exactly on schedule. Most investors will not realize it until the move is already over. Now you do.